Hey guys, this is me, Alex, and I'm here to show you a program I wrote that's for testing high-frequency trading and market-making strategies. So, a quick explanation of why I created this. I've been getting into algorithmic trading since I'm pretty good at computer programming, so I can write the code. And it's been really interesting. It's where you have computer programs trade for you. And I'm not really an expert on quantitative finance, but I was wanting to backtest strategies for market making and high frequency trading. But you can only really backtest on paper trading, which is testing historical data. You can really only do it for longer term trades, like a few hours or 30 minutes increments, or a few days even, because your trades affect the future outcome in high frequency trading and market making, obviously. So what this does is it's an environment that simulates the commodity market. And basically, there's 2,000 people who are producers of the good being traded on this exchange and 2,000 consumers. So the consumers will try continuously to buy, and the producers will try continuously to sell. Or the producers will try continuously to sell. So the way because there's two types of agents that trade, even past the producer and consumer. There's makers and takers. The maker will wait for someone to buy from them. They will list at a higher price than the current, or at the current, waiting for someone to buy. The takers will fill someone else's order. So with this, they're filling at the current bid. If they're a maker, they're selling, they're filling at the bid price or higher. So they could move the price a little bit, or they'll just build a thicker depth of market. Now you can adjust things like supply and demand. So you can adjust supply and demand, which is really neat, because the supply and demand, let me explain how that works. If it's at 187, like the supply is now, it'll generate a random amount for each agent. They'll generate a random amount to sell between 0 and 187. And so if there is a greater supply bar than demand, it should lower the price. And if there's a greater demand bar than supply, it should raise the price slowly, depending on the difference. And the liquidity is just the ratio of makers to takers. If I have a 100% liquidity, that means it's 100% makers. If I lower it to like 10%, 9%, you see it gets to be pretty crazy spreads, because it's mostly takers. There's hardly any makers. Even if I just have the spread 45%, it's still worse than what it was. But it allows you to adjust the various market conditions so that you can test tons of conditions for huge periods of time, because it's all simulated. You could go through months of trading days just in probably hours, depending on how good your computer is. I'm testing this on a laptop that isn't the most terrific, but it's still pretty good. So over here, if you look at the depth of market, it starts at the top, but that's really just where the price of 0 is. So if something were traded at a price of 0, and it goes down, it's sort of backwards, and I should fix it, but I never got around to it because it's not necessary to. And the red is the sellers, the blue is the buyers. And you can sort of see them trade real time in the depth of market. So this is the over here, this is the historical tick flow. This is the current bid and ask. And these are obviously the environment conditions. And what I've noticed is if the liquidity is lower, the price tends to move a lot quicker. 1 second. if you have the conditions, it tends to move a lot quicker if you have less liquidity. So there's a lot of things you can learn from this. One problem that I should state is the agents, there's no speculators, first of all. There's no speculators. And the agents that do trade are, they don't wait for specific price points. They just try to sell at the current price or buy at the current price, depending on whether they're consumers or producers. And that could be a problem because that's not really how the real world works. This is obviously a model that I created, so it's limited by its assumptions. I want to thank you guys for watching. I'll show the code real quick, actually. So there's two objects in this short little piece of code I wrote, and I'll leave the code in the description. If you're wanting to run this in processing, you're going to need Control P5 for the GUI. But anyways, there's two objects, exchange and trader. So a trader would be somebody who's trading on the exchange, producers and consumers in this case. And then the exchange has the matching engine, and it holds all the trades. So it's obviously not the most efficient memory-wise. All I needed it to do was work, and it does. So obviously, consumers, producers, and then the exchange, which shows right now 4,000 traders, obviously. And if you scroll down, the matching engine is Field Trades Logic. This is the matching engine. So it matches the buyers and the sellers together. And this is the run logic for anyways, so the code will be in the description if you want to tweak it yourself. I wanted to thank you for watching, and be sure to subscribe and like this video if you enjoyed it. Subscribe for more in the future if you think you want to see more algo trading related stuff. I might publish my quantitative finance backtesting framework that integrates with Quandel for data. But anyways, thanks for watching. I'm going to go ahead and stop recording. Be sure to leave a comment if you want suggestions or just to say hi. I'll say hi back. Hi, friend.